Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what is driving investment markets right now. We've had a 2-week break since the last show and it's been quite an interesting 2 weeks. Where we were 2 weeks ago, I started talking a lot about recessionary indicators and looking at things that could suggest that we are going to have trouble ahead, and also ways of looking at, with particular commodities, whether the trade war truce was coming or whether things would escalate. Now, last time it seemed that Donald Trump was actually taking his foot off the pedal in terms of the trade war angst that he was causing. He was actually making a bit of a U-turn by delaying some planned tariffs. Well, fast forward to the back end of last week and things on the trade war almost went nuclear. Not in a real terms of nuclear weapons, but in terms of the nuclear option that was open to Trump in terms of raising tariffs even further than some people had even anticipated. What started this is China finally retaliated directly to the previously announced tariffs from the US on Chinese goods by imposing tariffs on, or planning to impose tariffs on £75 billion worth of US goods. Obviously, the ego of Donald Trump couldn't take that, and he responded once stock markets had closed on Friday by announcing further tariff increases on Chinese imports. So we had the case of a increase from 25% to 30% on £250 billion worth of Chinese goods, and on another £300 billion worth of Chinese goods, he was going to increase the planned tariffs from 10% to 15%. Now, you can imagine what that did for US futures. Now, US futures are the market that can give you an indication where the cash market might open up and might trade in the next day. And on Sunday, when the cash market was closed, the futures were indicating that the market was going to drop 3% when it opened on Monday. Now, bear in mind, it already dropped about 2% on Thursday and Friday at the end of last week. So it started to look like there was going to be complete bloodbath in equity markets. And in fact, there have been a lot of traders who probably started to try and cash out of the market. Now, funnily enough, what happened come Monday, the bloodbath didn't materialize. And that was partly because Donald Trump started to talk up equity markets. And he did that by claiming that China had called to start to try and re-energize the trade war talks. They asked if they could start going back to the table. Now, China have since denied this has even occurred, and maybe it's not surprising that there seems to be little truth in Donald Trump's claims. He has been known to talk the market up before. So where have we been since the last show? The markets have basically whipsawed, and we've seen days where the market has fallen over 2%, rallied the next day over 2%. If you go and look at a chart on your iPhone, get up the stock market app, have a look at the last couple of weeks, and you can see we've been whipsawing up and down. It's very unusual to get that kind of movement and still be within touching distance of all-time highs. We have seen it before. Worryingly, we've seen it in previous market collapses just ahead of the financial crisis and in the Great Depression going back to the 1929. So it isn't necessarily a good omen, but the market is holding up. What we're actually seeing is, despite this whipsawing, this volatility over the trade war headlines, is that markets are range bound. So if you look at the S&P 500 in America, for example, we're range bound between, say, 2,850 and 2,950. We're going up and down. It's very volatile, and anybody who's trying to trade that is likely to get caught out or making decisions based on headlines. Now, last time I spoke about a particular commodity and said that 80/20 investor members were going to get a newsletter talking about this commodity and how it is a good indicator of future economic growth globally, but also on the likelihood of a deal between America and China. Now, go and have a free trial of 80/20 Investor to find out which commodity that was. But that commodity, with all these headlines going on, that commodity's pricing actually indicated that we were probably further from a trade war truce than we ever were. So before Trump's tantrum last week, and even before Trump has started to seem to do a U-turn, in fact, it showed that we were less likely to get a trade war. It seemed to show that the global economy was slowing. And of course, you fast forward to a week later, after we've had this tantrum, then that commodity seemed to be looking through the headlines and being a very good indicator of where we're going. So what's it saying now? Now that particular commodity is still suggesting that things are getting worse. We're seeing lower lows in its price, saying perhaps we're less likely to get a trade deal. And the news flow right now is seeming to agree with that. So we've got the VIX, the fear index in the US stock market jumping to around 20 again. We'd almost got back down to 15. So that level, a key level on the VIX, which seems to suggest below that is good for stocks. Above that is slightly more negative for stocks. We're back up to about 20, which is the long-term average. And it's been interesting because at the start of August, it looked very much like the start of May. So where we had the Trump escalation of that trade war, then we had defensive stocks leading. We had bonds doing very well. Then when Trump seemed to do a U-turn, that started to slightly unwind and we saw some of the tech stocks doing better. But of course, the latest development in the trade war has seen the defensive start to outperform again. So where are we? It started to look like August is ending very much like May did. So we've got to see what happens in the coming days. Bond markets are doing very well. Yields are now getting lower. Now we're seeing more and more negative yields. And in fact, the 10-year US Treasury yield is down to 1.47, which is completely mind-boggling. So bond investors have been winning handsomely. And so too, in fact, have those buying gold. As for those recessionary indicators, I talked about the yield curve inverting. They're getting worse. So we are in a worse position based on those indicators than we were 2 weeks ago when I did the last video. So right now, equity markets are starting to refocus on those. Despite all the headlines, they're starting to get more and more concerned. Now, for UK investors, one of the biggest things that's having an impact now is Brexit. So the latest news is that Boris Johnson is trying to disband Parliament early so he can force through a potential no-deal Brexit. Now you can imagine the pound didn't like that. It had, over the last 2 weeks, started to strengthen ever so slightly and it got above $1.22, heading towards $1.23, but it's now started to reverse that trend and is heading back towards $1.22 and possibly below. So for UK investors, the movement of the pound in the next month or so is going to be crucial. So it's two egos, the ego of Donald Trump, who didn't like the retaliation by China, which was inevitable. He has rocked the boat once again by throwing a tantrum. And of course, in the UK, we've got Boris Johnson, who is determined to seemingly want to take us out of Europe, even with a no deal, which is also rocking the boat. So with two egos, they're going to collide. Who knows what's going to happen in investment markets. So that is it for this week. As ever, you can follow me on Twitter. Money to the masses with the number 2 is the handle. You can email me, Damien at moneytothemasses.com. And of course, you can find us on YouTube and Instagram.